This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We are diving into a packed slate of tech legal battles, shifting financial markets, and the growing global impact of the conflict in the Middle East today.
Elon Musk pitched Mark Zuckerberg on bidding for OpenAI's assets.
Courts found Meta and YouTube liable for designing addictive apps.
The Dow Jones entered correction territory amid rising war fears.
Millions of student loan borrowers must restart payments this fall.
Sony is hiking PlayStation 5 prices due to component costs.
Iran maintains its blockade of the vital Strait of Hormuz.
UK government borrowing costs hit their highest since 2008.
AI agents are fueling a surge in one-person companies.
Researchers found millions in suspicious profits on prediction markets.
Britain faces potential medicine shortages as the Iran war continues.
First, the Musk lawsuit. Newly unsealed court documents have revealed a fascinating exchange between Elon Musk and Mark Zuckerberg. In February 2025, Musk reached out to the Meta CEO to see if he would be interested in joining a bid for OpenAI's intellectual property. This happened just before Musk's XAI-led consortium made an unsolicited $97 billion offer for the organization. The text shows Zuckerberg was initially helpful, offering to have his teams monitor for doxing against Musk's Doge staff, but he seemingly hesitated when the conversation turned to a joint multi-billion-dollar acquisition of OpenAI.
It is a wild look behind the curtain of these tech titans. While Zuckerberg asked if Musk wanted to discuss the bid live, OpenAI later clarified in court filings that neither Zuckerberg nor Meta actually signed the letter of intent. Musk's legal team was essentially trying to block OpenAI's transition into a for-profit entity by buying up the IP. This disclosure highlights how Musk was actively recruiting his rivals to dismantle OpenAI's current structure. Despite the heart emojis and late-night texts, the partnership never materialized, leaving Musk to pursue the aggressive bid with his own investor group. Next up,
the tech industry is facing what many are calling its big tobacco moment. A Los Angeles jury recently found Meta and YouTube liable for deliberately designing addictive products that harmed young users. The case centered on a 20-year-old named Kaylee, who became addicted to social media as a child and suffered from depression and self-harm. This verdict is a massive blow to the perceived invincibility of Silicon Valley giants. Jurors expressed a desire to make these companies feel the consequences of their design choices, signaling a major shift in how the legal system views the responsibility of social media platforms.
This wasn't the only legal setback for Meta this week. A New Mexico court also ordered the company to pay $375 million for misleading consumers about platform safety. The state's Department of Justice argued that features were intentionally designed to hook children while enabling predators. With thousands of similar lawsuits pending, the financial and regulatory pressure is mounting. Even figures like Prince Harry have commented on the precedent being set. If these companies continue to lose in court, the damages could become crippling, potentially forcing a fundamental redesign of how Instagram, TikTok, and YouTube actually function.
Now let's shift to the stock market is feeling the heat from global instability. On Friday, the Dow Jones Industrial Average tumbled nearly 800 points, officially entering correction territory. This means the index has shed 10% of its value since its February peak. Investors are deeply concerned that the ongoing war with Iran will lead to long-term disruptions in energy supplies from the Persian Gulf. Crude oil prices are surging, and there is a growing fear that this will trigger a fresh wave of global inflation. The S&P 500 and the Nasdaq also saw significant declines as the market's optimism continues to evaporate.
Consumer sentiment is also taking a hit, reaching its lowest level since late 2025. Economists note that when a country goes to war, people naturally anticipate higher prices and investment volatility. This time, the unease is particularly sharp among middle and high-income consumers, who are more exposed to the stock market. The conflicting messages from Washington and Tehran aren't helping. While President Trump suggests negotiations are going well, Iran continues its blockade of the Strait of Hormuz. This pattern of conflict intensification, followed by brief restraint, has created a volatile cycle that is keeping the financial markets on edge.
Moving on, millions of student loan borrowers are about to see a major change in their monthly budgets. The Department of Education has announced that those enrolled in the SAVE plan will have to transition to new repayment options starting this July. The SAVE plan, which was a cornerstone of the Biden administration's effort to provide cheaper payments and faster forgiveness, is being eliminated following a legal settlement. Borrowers will have a 90-day window to select a new plan. If they fail to act, they will be automatically moved to a standard repayment plan, which could result in significantly higher monthly costs for many families.
The Trump administration is taking a firm stance on this, with officials stating that the policy is simple. If you take out a loan, you must pay it back. This marks the end of a period of uncertainty for the 7 million people who were on the SAVE plan, which had been blocked by litigation since last summer. While a new repayment assistance plan is being introduced, it is notably less generous than the previous options, requiring 30 years of payments before relief is granted. Borrowers are being urged to contact their loan servicers immediately to explore their options before the mandatory deadlines hit.
Next up, gaming is getting more expensive as Sony announced a $100 price hike for the PlayStation 5 in the United States. This brings the standard console price to nearly $650. Sony points to the rising costs of memory chips as the primary driver. The tech industry's massive push into artificial intelligence has created a shortage of consumer-grade chips as manufacturers prioritize high-margin components for AI data centers. Additionally, the conflict in the Middle East has threatened the supply of helium, which is essential for semiconductor manufacturing. This is Sony's second price increase in less than a year.
The price hike isn't just limited to the US. Europe and Japan are seeing similar increases. This comes at a tough time for the gaming market, as console sales have already been sluggish. Sony reported a 16% drop in PS5 sales during the recent holiday quarter. Analysts warn that these higher prices will likely dampen growth even further. Even the high-end PS5 Pro is seeing a jump, now costing $900. With Microsoft also raising Xbox prices recently, the entire console landscape is becoming a luxury market, driven by the dual pressures of the AI boom and geopolitical instability affecting global supply chains.
Now let's discuss. The situation in the Middle East is escalating as Iran maintains its firm blockade of the Strait of Hormuz. The Revolutionary Guard has declared that no ships can pass without explicit permission from Tehran, causing global crude oil prices to spike above $110 a barrel. This week, the Iranian Navy turned back 3 Chinese-owned container ships that attempted to navigate the strait. These vessels were forced to make sharp U-turns near Larak Island, which has effectively become a toll booth, where Iran is reportedly charging ships millions of dollars for safe passage. This choke point is critical for 20% of the world's oil.
The pressure isn't just on the Strait of Hormuz anymore. Iran is now threatening other vital shipping lanes in the region, which could further isolate global trade. Data from maritime tracking services shows that transits through the traditional southern route have completely stopped, with all traffic now forced through the Iranian-controlled corridor. This aggressive stance by the IRGC is a direct challenge to international shipping norms and has created a massive bottleneck for global energy supplies. As long as this blockade remains in place, the risk of a sustained energy crisis grows, impacting everything from gas prices at the pump to international manufacturing costs.
Next story. In the United Kingdom, government borrowing costs have surged past 5% for the first time since the 2008 financial crisis. This spike is part of a global bond market sell-off triggered by the ongoing Iran war. Investors are increasingly skeptical of the ability to reach a swift peace deal, leading to a sense of panic in the markets. The yield on 10-year debt rose 13 basis points on Friday alone. This turbulence isn't limited to the UK, as borrowing costs for the US and Eurozone governments are also climbing. The financial system is bracing for a significant inflation shock caused by high energy prices.
The Bank of England is under immense pressure to act. Traders are betting that interest rates will need to rise even more aggressively to combat stubbornly high inflation. This creates a difficult situation for the UK government, which is already facing a cost of living crisis. Higher borrowing costs mean the government has less flexibility to provide financial support to struggling households. Economists warn that the UK might be more vulnerable than other nations due to its heavy reliance on global trade and sensitivity to oil prices. The market's loss of faith in a diplomatic resolution is making the economic outlook increasingly grim for the British public.
Moving to China is experiencing a massive boom in one-person companies thanks to the rapid advancement of AI agents. Alibaba.com president Kuo Zhang reports that nearly 40% of their customers are now solo entrepreneurs. These individuals are using AI tools like OpenClaw to handle tasks that would normally require a full team, such as managing social media, customer service, and tax compliance. In some Chinese cities, the government is even offering free housing and significant subsidies to attract these AI-driven startups. This shift is transforming the e-commerce landscape, allowing individuals to compete with much larger corporations by automating the daily grunt work of business operations.
Alibaba has leaned into this trend by launching Apptio Work, an AI agent specifically designed for small businesses. It helps with everything from logistics to product listings, acting more like an employee than just a software tool. The main Apptio agent already has 10 million monthly active users. While these solo entrepreneurs face challenges like international tariffs, the ease of using AI is lowering the barrier to entry for new businesses. Zhang believes that AI is fundamentally changing the perspective of what a small company can achieve. It's no longer about hiring a large staff, but about how effectively you can deploy your AI agents.
Next up, a new study from Columbia Law School has uncovered what it calls anomalous profits on the prediction market, poly market. Researchers found that a group of informed traders netted $143 million since 2204 by making highly suspicious bets. One specific account, known as Rikasuave 666, made thousands of dollars betting on Israeli military strikes just hours before they occurred. These trades were flagged for their uncanny timing, suggesting that some users may have had access to non-public information. The study analyzed over 200,000 trades, highlighting a significant amount of activity that appears to be driven by more than just lucky guessing or market analysis.
The researchers used the term informed trading to describe these gains, noting that some bets were placed in markets where the outcome could be influenced by those with inside knowledge. While some of the largest trades were related to the 2024 election, the most suspicious ones involved military and geopolitical events. This analysis is intended to help regulators understand the potential for insider trading within prediction markets, which have exploded in popularity recently. As these platforms become more mainstream, the pressure to implement stricter oversight is growing. The goal is to ensure a level playing field for all participants, rather than allowing those with secret information to dominate.
Finally, the UK is reportedly just weeks away from serious medicine shortages if the conflict in the Middle East persists. Experts warn that everything from basic painkillers to critical cancer treatments could be affected. The disruption stems from the closure of the Strait of Hormuz and the limited operations of major airports in the region. India, often called the pharmacy of the world, produces a huge portion of the UK's generic drugs, and getting those supplies out is becoming increasingly difficult. Pharmaceutical companies are being forced to reroute shipments by sea, which significantly lengthens delivery times. This perfect storm of supply chain risks is putting the NHS in a precarious position.
While there isn't an immediate crisis today, the window is closing fast. Most medical distributors only hold about 6 to 8 weeks of stock. If the war drags on, those reserves will be depleted. Furthermore, the cost of air freight has doubled, putting immense financial pressure on manufacturers who already operate on thin margins. There is a real risk that some medicines will become loss-making to supply, leading to even fewer options for patients. While the UK produces about half of its own medicines, the reliance on international active ingredients means that no part of the healthcare system is truly immune to these global geopolitical shocks.
That wraps up our briefing for today. Thank you for joining us for this daily roundup of the most important stories. We will be back tomorrow with more updates.